Hi there, and welcome to another episode of Sidekick TV. This week we're joined by a familiar face of Paul Garner from Mortgage Life, and we just want to give our listeners here the quick update on the OCR changes. So Paul, can you give us a real quick update? What's happened with the OCR this week?
Yeah, so awesome news this week. We got the 0.5 cut, which was kind of expected somewhat over the last couple of weeks. We were thinking it was probably going to be a 0.25, but good to see them push through. It's actually been needed. We've been saying for a long time, like across the country, there's a lot of Kiwis doing it hard, and that it's, cost of living across everything at the moment is getting a bit ridiculous. So great to see that pull through. I think the big one leading into Christmas though is that we're going to have this mad rush, and as we know with business, it's the lead up into Christmas. People tend to be a bit slow paying in December. We wind down in January, get back late, and then back into the swing February. So some of those payment cycles might end up being March before we get paid. So it's good timing with the expenses and bits and pieces, but also just bearing in mind that a lot of people are still fixed in on the longer term, so won't actually get any relief from this till end of next year. So it's only those new transactions that are actually going to benefit from this, but good sentiment anyway.
So Paul, we don't see these mortgage changes coming out overnight. How does this play out for most like self-employed people?
Yeah, so the money doesn't seem to roll through for probably another 6 to 8 months for a lot of people, depending on their fixed term. So if we go back to the start of the year, there was sort of murmurs that the OCR wouldn't move too far below sort of 3, and they were pretty firm on that. We've seen that obviously not be the case. So we're going to see a lot of people that are getting the energy back into the markets improving, which is great. The banking test rates and bits and pieces, if you're looking at doing maybe a new transaction, buying gear or investing of a mortgage, that's going to get a bit easier, but the money actually rolling through from these cuts is probably six months to 8 months, depending on people's fixed periods. So I think that's something to keep in mind, that it's not something that's going to be an instant relief of money back into people's back pockets overnight. It is only those that are basically doing something right as the second that they're going to benefit from it.
Yeah, right. And that's one thing to be aware of if you're a business that relies on consumer spending or that middle bracket market. All of your clients haven't just got an extra $500 a week in their pocket, have they? Like, this is slow to come out. So it's positive, but it's not instant.
Moving in the right direction, but yeah, not a silver bullet in terms of any time soon. Maybe if you're in those sectors where people are getting into, say, new construction and doing a new build, those build rates have come back a wee bit, and then it's really, really cost effective to do a brand new build now. So if you're in those sectors, maybe you're probably gearing up and looking pretty good for next year's work. But yeah, those in terms of that are in this current position that are retail businesses, they won't be seeing any of that sort of pull through anytime soon, depending on timing, of course. But also a lot of people couldn't actually afford, knowing that rates were going to fall, they actually couldn't afford to take a 6-month or a 12-month term because the interest rates were higher. So they've gone with a 2-year fix at the start of the year, or maybe the end of 24. So they're not up for renewal for quite a wee while.
Yeah.
And I think that's just a point that's sometimes missed in the scheme of things. They couldn't actually afford to, they knew it was going to likely drop, but they couldn't actually afford to wait.
Yeah, that's a great, because that's it. It's been, relatively speaking, so expensive, hasn't it? So the can of float for 3 months, just not an option because couldn't cash roll it.
Yes, exactly. And it's where I think across New Zealand where I've seen the biggest changes, it's not the discretionary spending. Like we've always been told at times, our younger generation tend to consume quite a bit, but where I've seen the biggest changes across, your rates, your insurance, you've got to have medical cover now because you can't rely on DHBs and bits and pieces at the best of times. They all do a great job, don't get me wrong, but there's these fixed costs now that have probably never been there. Your insurance for your home was always cost effective, your content's cost effective. Now those things just keep ramping up, fuel, food, and it's really taking the money out of the pay packets.
And it's happens at the beginning, eh? You receive a lot of people, they receive their income. For so many people, that's fixed.
Yep.
And then you've got $1,000 going out for your insurances for the month. You've probably got 2.5 or more coming out for your mortgage, and that's just all gone on day one. So it's the discretionary spending's barely there.
it's gone. Yeah. So I mean, it'll be good when the rates start cycling through for people for sure.
Yeah, great. Right, so Paul, where are we seeing that this is actually really good news?
Yeah, so good question. Really good news is obviously with the OCR cuts, the bank will counter with test rates. So for simplicity, test rates are what the banks are benchmarking people's lending against. So essentially when the Reserve Bank lowers those rates, the bank reduces their test rates down so people have more affordability. So it's really important for those that maybe were pre-approved for something 3-4 months ago. There's been a few changes, so updating that to make sure that they're in line with the market. So their pre-approval, they might have been pre-approved for 500, say 3-4 months ago. That might be 550 now. So making sure that they're up to date with that. The other thing is we're going to be seeing maybe people have a bit more scope to invest in business or look at an investment property. With the interest rates dropping back a wee bit, the likes of interest only coming back in for 10 years on investment, we're seeing it starting to stack up now for people to look at that as an option, whereas when rates are sort of late 5s, 6s, it gets pretty hard to make those things stack up.
So Paul, with this good news around, we've got lower interest rates now essentially, what's some positive stuff you're seeing people planning to do with this?
Yeah, so I think people have been a bit more deliberate with their, I guess, replacing equipment in terms of business or bringing on staff because it's starting to get a bit more cost effective to lend money to do that. In the residential space, we're seeing a lot more people maybe move towards doing a brand new build versus a existing purchase because the bank's the bank's blueprint to build or back my build, which is a special offering for new purchases, new builds. They're sub 5 interest only throughout that period. So they're really good incentives for people to maybe choose new, which is really positive.
And that should spin out a bit more into the construction industry, obviously, provide more housing. Yeah, right.
Absolutely.
Positive,
really positive in that space. And there were the loan to value ratios where you could get in with a lower deposit as well. So that combination with a 1.25% discount on a floating loan throughout the build is crazy. So I've got a few clients that are floating around the late 4.75ish floating on a build
based on the drawdown as well. So it's just slowly growing.
It's just on as it progresses through. And so at that point in time, a couple of them that we've actually completed, we're just sitting there and watching because
you don't want to fix.
There's no point in probably taking the 1 year fixed at this stage. So there's some good positivity there, but I think now is probably a good time if you were going to look at investing in the business or investing in buying a rental property, that we've got to where we need to start making things stack up, and if you want to kind of go after it, it's there for you.
Get rates are feeling kind of normal again.
Normal. And it's what we've been asking for a long time. It's just, I think people need to be mindful of, we've been wanting a sub 5 rate for a long time, or a low 5. Now that we've got it, when we're talking about the future position, we've got to sort of take the good and also protect for the longer term. So if you're looking at your fixed structure, maybe you take sort of a 1 or a 2, or you hedge your bets a wee bit. Don't be greedy and just go into that 1 year cycle as we've seen in the past, which actually got us into a lot of strife over the last few years if we've seen through business. So don't be scared to sort of break those lending amounts up and actually scatter a wee bit, hedge your bets.
So Paul, with the OCR drop, what are you actually expecting the banks to do, and what kind of timing?
Yeah, so we've seen banks already move probably a week before the OCR, so rates on the 1 year, 2 year pulled back quite nicely, and then obviously Wednesday came through, which was great. Usually there's a bit of a yo-yo phase where someone will sort of drop by 0.1 and then the others will follow, but it usually takes a couple of weeks. There is another OCR announcement next month, which will be very interesting to see what happens there going into Christmas especially, but I think we'll start to see rates still sort of sit where they are, maybe sort of a 0.1 or a 0.05 cut further, but I think with the way that the market's moving, there potentially could be further cuts that pull through into next year to keep, I guess, the stimulus going, because we need it. But again, bearing in mind any future cuts, we're still not going to see any benefits of those further cuts until, probably middle of next year. So the cuts that are actually being implemented will only stimulate the new stuff that's happening, not existing people, which we need to actually be getting a bit more money back into their back pockets.
And that's the bulk of the market, isn't it, at any given time?
Completely, yeah. It's not just the new first home buyers or the new builds that are going on. It's the bulk of the market that are already sitting on a 5 or some are on 6% that we need to get a bit more back into their back pockets.
I think everyone's becoming a bit more aware of like what the official cash rate is, because we've been talking about it and hearing about it for the last few years, but still it's pretty tough small business owners to be an expert at this. What are we saying do we send them off to the banks and bank managers, or a broker? What's your recommendation now?
Yeah, I mean, biasly, mine's always to obviously come see someone like myself or a good broker out there that actually has experience. I think the biggest change I've noticed over the years from being in banking and now being out in the market is there's a lot of cues, or there's a lot of changes that happen in the market that don't correlate through to OCR announcements or updates. And it's a weird thing to say, but it's that gut feel in the market. So I've been saying to a lot of clients for say 6-12 months that I felt that the market needed to react in terms of reduction in rates to get money into back pockets, because it's just been so tight out there. And often you see the economists come out with updates and bits and pieces, how often do they actually get it right? It's, a broken clock's right twice a day, but not, again, saying that they don't do a good job, but there's the element of they commentate the market, and it's the same at the start of the year. We were saying that the OCR wasn't probably going to go sub 3. They were saying that we're at 2.5. And so I think get out there, speak to people that are actually in and get good advice around your structure and your position, because it's not just about the current position, but it's also protecting you for the long term, where I don't want to see any of my clients in future that are rolling off a 4% and into a 6%. We've got to learn lessons for what's happened, and we've got to educate around that, and we're seeing it on the daily. So you're not going to probably get that from a frontline banker that is just sending you through your 5-year rate fix and then telling you, hey, this is your options. Well, you're the expert, so you tell me. And so I think, that personalised approach to people's positions is so important, just not for the short term, but the long term as well.
Yeah, perfect. No, good advice. Thank you. So, Paul, does this change mean that there's any more appetite across the banks?
Yeah, I definitely think there is. It all depends on what you're looking at doing. So if you're doing a brand new build, I would say there's 2 leaders in that space at the moment with what they can offer. I guess that's another good point around in terms of if you're going direct to the bank, you're getting one source of truth. You're not getting the market options or someone giving you a steer on that. And all the banks have their strengths and their weaknesses. Some may be, just their turnaround times. We've got a short deadline and we need to move. And so I think it's important getting that market overview, not just the one. But yeah, there's definitely going to be a lot more competition for business. We're already seeing it already with a few changes out there, but it's just, again, working out what you're wanting to achieve and who's the best for that to make it fit your plans, not just, push it into what it needs to be to get it across the line.
And that is one thing that, I see it all the time in my day job, is that it's amazing the different appetites that banks have. Hey, a great deal might be turned down by one bank and then just absolutely adored by another, eh?
And it changes so aggressively as well, and that's why I think you've got to have, you've got to be plugged, as an advisor, you've got to be plugged in, you've always got to sort of be submitting your own deals and dealing on the front line. Case in point is in the commercial and business space. At some stage, commercial agents that I've spoken to have said they've been the bank's been closed for the last couple of years, and now, boom, it's back up and running and everyone's into it. And so it's changing, and it's changing really aggressively, but from the client's point of view, it's not your job to navigate that. You need someone who's living and breathing it and actually can guide you on that.
Yeah, perfect. No, cheers for that.